Trading in the stock market is an exciting endeavor, but it comes with important choices. Do you crave the thrill and intensity of day trading, or do you prefer the calculated patience of swing trading? As always, thanks for tuning in, and if you find value, please do hit that like button. It really does help the channel. Today, we're breaking down day trading on intraday charts versus swing trading on weekly charts, which one is right for you, and which offers the greatest returns. For most new traders, day trading is the easiest and most exciting way to dive into stock trading. The idea of taking multiple trades each day, making small profits on each one, and amplifying those gains through leverage is enticing to many. On the other hand, swing trading is better suited for the more patient trader. While it lacks the fast-paced thrill of day trading, it offers the potential to build significant wealth over the long term with relatively low risk. Both approaches come with their own sets of pros and cons, so let's break them down based on some key factors. The first factor to consider when comparing these strategies is the trader's commitment of time and effort. In day trading, you need to be actively involved during market hours. Your day typically starts before the market opens, researching what to trade and planning your strategy. However, this plan can quickly change based on how the market behaves throughout the day. Day traders constantly shuffle through multiple charts on smaller time frames, ranging from minutes to hours. Trading on intraday charts demands full-time focus. It's not something you can actively manage alongside a day job. On the other hand, swing trading doesn't demand as much time during market hours. You can even automate parts of the process using alerts and triggers to open and close trades. While research and scanning do require some initial time investment, this effort decreases significantly once you've streamlined your process and developed a system for identifying top trades. I've built such a system through decades of trading experience, significantly reducing my research time. The second factor to consider when choosing between day trading and swing trading is the leverage involved. In day trading, brokers often offer higher leverage since positions are closed within the same trading day, minimizing the risk of overnight market fluctuations. This enables traders to control larger positions with less capital, amplifying both profits and losses. However, higher leverage also increases the risk of margin calls and rapid account depletion if a few trades move unfavorably. On the other hand, swing trading typically involves lower leverage, as positions are held for several days, weeks, or even months. Since traders are exposed to overnight risks, brokers often impose higher margin requirements to account for potential market gaps and price swings. While this limits the potential for extreme short-term gains, it also lowers the risk of rapid account liquidation caused by excessive leverage. Leverage impacts each trading style's risk management. It influences capital allocation, trade sizing, and overall strategy. It's essential to assess your risk tolerance and financial capacity before choosing the approach that best aligns with your goals. The third factor to consider when choosing between day trading and swing trading is the level of emotional engagement each approach requires. Day trading involves executing multiple trades within a single day, demanding intense focus, quick decision-making, and the ability to manage high levels of stress caused by rapid market fluctuations. Strong emotional resilience is essential to succeed as a day trader. On the other hand, swing trading involves holding positions for several days or weeks, requiring patience and the ability to manage emotions over a longer period. When using weekly time frames on charts, daily fluctuations become almost negligible. Weekly charts offer a clearer view of trend structures, helping reduce emotional overreactions to minor price movements. While swing trading isn't as fast-paced as day trading, it still requires traders to navigate market volatility and handle the uncertainty of overnight price shifts. Although overnight movements can initially cause anxiety, this eases with experience. Additionally, since swing trading typically uses less leverage than day trading, it's easier to stay calm during turbulent market conditions. Therefore, understanding one's emotional tolerance and ability to manage stress is crucial in selecting the most suitable trading strategy. The next factor to consider when choosing between day trading and swing trading is the signal-to-noise ratio, especially in the context of institutional psychology. Institutional investors, such as hedge funds, mutual funds, and proprietary trading firms, play a significant role in shaping market movements, and their influence varies across different timeframes. Intraday charts are filled with a high degree of noise, rapid price fluctuations driven by algorithmic high-frequency trading, or HFT, news events, retail speculation, and short-term liquidity imbalances. Large institutional players often use algorithms to create false breakouts, shakeouts, and liquidity traps to exploit retail traders. It's not uncommon for a single large institutional trader to trigger your stop loss on a leveraged position, only for the price to quickly reverse. This makes it challenging for day traders to distinguish between genuine trading signals and manipulative price action designed to trigger stop losses and provoke panic selling or FOMO-driven buying. Therefore, a lower signal-to-noise ratio on intraday charts requires traders to develop the skill to filter out deceptive moves and focus on high-probability setups with clear institutional footprints. In contrast, swing trading on weekly charts operates on a higher signal-to-noise ratio because price action over multiple days or weeks reflects broader institutional strategies. Large funds cannot enter and exit positions within minutes without significantly impacting prices. Instead, they accumulate or distribute shares over time, creating more sustained and meaningful price trends that swing traders can capitalize on. Swing traders who understand these institutional behaviors can identify accumulation or distribution patterns, aligning their trades with the smart money rather than getting caught in short-term volatility traps. In a nutshell, those who thrive in fast-paced environments and can quickly adapt to market noise may prefer day trading. Meanwhile, traders who seek to align with institutional movements and avoid the erratic nature of intraday price swings may find swing trading more suitable. Another big factor to consider while choosing between day trading and swing trading is the ease of trend following. Big money is always made in trends, and as a day trader using intraday charts, you limit yourself from capitalizing on longer-term trends that could potentially transform your trading career. Since day trading requires closing positions by the end of the day, you miss out on multi-bagger moves that unfold over extended periods. It's different with swing trading on weekly charts. Most big trends are driven by underlying fundamental factors such as quarterly earnings, macroeconomic shifts, and industry trends that take time to materialize. Weekly charts are better suited to align with these developments. As a swing trader, you can capitalize on these fundamental shifts even without an in-depth understanding of the underlying fundamentals of the stocks you're trading. You just need to follow a proven system, like mine, to catch those trends. Our approach, backed by our custom-built scanner, aligns a stock's fundamentals with the structure of weekly charts. I found this to be the sweet spot for compounding equity over the long term without demanding too much of my time. The last factor to consider while choosing between day trading and swing trading is the overall risk. In day trading, the use of high leverage amplifies both profits and losses, increasing the risk of margin calls or account depletion if trades go beyond expectations. Additionally, while using intraday charts, you must contend with unpredictable market events, such as economic reports or news releases, which can cause sudden reversals. Swing trading carries lower intraday stress and risk, but exposes traders to overnight and weekend risks. Market gaps due to earnings reports, geopolitical events, or macroeconomic shifts can lead to unexpected losses. However, longer holding periods allow for trend-based strategies, reducing the impact of short-term fluctuations. From a pure risk perspective, choosing the right approach between the two depends on your risk appetite, psychological resilience, and trading discipline. In my opinion, which is backed by empirical evidence, most wealth in trading has been built through swing trading. Many of the great traders of recent times, including Mark Minervini, William O'Neill, and Christian Kulumagi, all of whom we cover on the channel, are swing traders. Yet, despite this evidence, millions of new traders dive into day trading each year, some even looking at minute charts chasing quick riches, only to blow their accounts and eventually return to their day jobs. Success rates in day trading are abysmally low, with studies showing that only about 1% of day traders consistently make money in the long run. That stat alone speaks volumes. The odds are significantly better in swing trading, where 10 to 30% of traders achieve long-term success, provided they remain disciplined and apply strong risk management techniques. Personally, I would choose the steady path of swing trading any day over the stress and heightened risk of day trading. I can say with significant confidence that with the right strategy and mindset, you can become part of the 1% who actually generate wealth through trading. If you want to fast-track your learning curve, consider joining our group. You'll gain access to our vibrant Discord community, a custom-built breakout scanner, my weekly report featuring all my past and upcoming trades, and my ebook, which details every aspect of my trading approach. As always, thanks for watching, and be sure to use our links below for all that we offer.